The stock we're looking at for the end of April is AIRT with ticker symbol AIRT. Here we see the quote from Friday, $9.48. AIRT operates in the overnight air cargo segment through subsidiaries Mountain Air Cargo Incorporated and CSA Air Incorporated. This segment accounted for 51% of revenue in 2011, with FedEx being the main customer. Another subsidiary they own is Global Ground Support LLC. GGC provides equipment to passenger and cargo airlines, airports, as well as military and industrial customers. The main customer for this segment in 2011 was Delta Airlines. This table shows us the earnings per share for AIRT for the last 7 years, which allows us to determine the 3-year average PE ratio, which is 6.75, while the 7-year average price to earnings ratio is still a very cheap 8.19, indicating that AIRT is currently providing value to investors. The return on invested capital numbers are also very good. Last year 7.7%, while the 5-year average a very impressive 15.6%. The current dividend yield for AIRT is 2.64%. Some other numbers to consider: AIRT is actually currently trading at less than book value, with the price to book ratio being 0.88. In addition, they also have good financial health with a capital to liabilities ratio of over 4. The chart we see here for AIRT for the last several months shows us that the stock has actually been performing quite well this year and is actually close to its 52-week high of 989. However, it's far from its high PE ratio of last year at 15, as was referenced in the previous slide. So I think that AIRT still has room to the upside. Of course, risks include they would of course be affected by a declining economy, as less air shipments would be completed. However, based on the financial ratios mentioned in the previous slide, the low PE ratio, as well as trading less than book value currently, it definitely looks like an interesting stock to consider at these levels. That sums it up for this edition. Remember to check the site with the address here for the next post. Thanks. Bye.